Have you ever wondered why some people seem to grow their money effortlessly, while others struggle no matter how hard they try? It's not about working longer hours or getting lucky. The secret lies in something called compound interest. It sounds complicated, but it's actually one of the most powerful tools you can use to build wealth over time. Understanding it can completely change how you save, invest, and think about money. By the end of this video, you'll see why starting early, even with small amounts, can make a massive difference in your financial future. 10. Compound interest isn't just about money. When most people hear the term compound interest, they immediately think of savings accounts or investments. But the idea of compounding applies to much more than money. It's really about growth over time. Think about learning a skill or improving your health. Small improvements, repeated consistently over years, can turn into major results. With money, even a tiny amount saved and invested early can grow into something significant. For example, putting aside $50 a month at a 7% return might not feel like much today, but over 30 years, it can turn into tens of thousands. Compound interest rewards patience and consistency more than large one-time contributions. 9. Understanding the formula. You don't need to be a math expert to benefit from compound interest, but understanding the formula helps make sense of why it works. The formula is A equals P times open parenthesis 1 plus R divided by N close parenthesis to the power of NT. Here, A is the future amount you'll have, P is your starting money, R is the annual interest rate, N is how often the interest is applied per year, and T is the number of years your money grows. Essentially, every time the interest is calculated, it is added to your initial investment. Then, the next calculation earns interest on the new, bigger number. This is the compounding effect in action. Even if the numbers seem complicated, the main idea is simple. Your money earns interest, and that interest earns interest too. 8. Start early to maximize growth. One of the biggest advantages of compound interest is that time is on your side. Starting early can make a huge difference in how much your money grows. Let's say you save $100 a month at age 25 with a 7% return. By the time you are 65, that small monthly contribution could grow to nearly $250,000. Now imagine starting at age 35 with the same amount. By 65, you might only have about $130,000. The extra 10 years allow compounding to work its magic. The key lesson is simple. The earlier you start, the more time your money has to grow, and even small contributions can add up dramatically. 7. Small contributions add up. Many people assume they need a lot of money to benefit from compound interest, but that's not true. What matters most is consistency over time. Even putting aside $20 or $50 each week can make a huge difference when compounded over decades. The power of small contributions is that they allow compounding to work gradually, turning modest amounts into significant savings over time. Missing a week or two occasionally won't derail your progress, but building a habit of regular saving is crucial. The real magic happens when these small contributions continue uninterrupted for years. Think of it like planting seeds in a garden. A few seeds planted consistently grow into a large harvest. By starting small and staying committed, you make compounding work in your favor without feeling the strain of huge deposits. Over time, your future self will be grateful for the discipline you built. 6. The effective interest rate. The interest rate you earn plays a huge role in how fast your money grows. Higher rates accelerate growth, even if you're contributing the same amount each month. For instance, an account earning 5% annually might double your money in roughly 15 years, while an account earning 7% could double it in just 10 years. Even small differences in rates can create significant gaps in wealth over decades. This is why it's important to choose investments that beat inflation, so your money not only grows but maintains its purchasing power. Understanding the impact of interest rates helps you make smarter decisions about where to save or invest. It also encourages you to seek options that maximize growth without taking excessive risks. By paying attention to rates and letting time do its work, you can take full advantage of compound interest and reach your financial goals faster. 5. Frequency of compounding matters. How often your interest compounds also makes a difference. Interest can be compounded annually, quarterly, monthly, or even daily. The more frequent the compounding, the faster your money grows. For example, $1,000 at 5% compounded annually becomes $1,050 after 1 year. Compounded monthly, it grows slightly faster to around $1,051. It doesn't seem like much in 1 year, but over decades, the difference is substantial. Choosing accounts or investments that compound more frequently gives you an extra edge without needing to add extra money. Every little bit counts when compounding is involved. 4. Reinvesting is key. To make compound interest work best, you need to reinvest the interest you earn. Every dollar of interest that stays invested earns more interest. If you withdraw your earnings each year, you lose the compounding effect. Think of it like planting seeds. If you keep planting new seeds from the ones that sprout, your garden grows exponentially. Reinvesting your interest may feel small at first, but over years, it creates a massive impact on your total wealth. Letting your money grow undisturbed is one of the simplest ways to harness the full power of compounding. 3. Inflation can be a hidden enemy. Compound interest is a powerful tool for growing your money, but it's important to remember that inflation can reduce its impact if you're not careful. Inflation is the general rise in prices over time, which means the money you have today will buy less in the future. For example, if your investments earn 5% annually, but inflation is 3%, your real growth is only 2%. That's why it's crucial to choose investment options that have historically outpaced inflation, such as stocks, index funds, or certain bonds. Understanding inflation helps you see the true value of your money over time and ensures that your savings maintain their purchasing power. Even with consistent saving and compounding, ignoring inflation can make your growth feel smaller than it really is. So factoring it in is essential for long-term financial planning. 2. Compounding works in reverse too. While compound interest can grow your savings, it can also work against you with debt. High-interest loans, like credit cards or payday loans, grow just as quickly. A $1,000 balance at 20% interest can quickly balloon if unpaid. What makes this worse is that many people only make minimum payments, allowing interest to compound on unpaid balances. Understanding this is crucial because debt can grow faster than your savings if ignored. Treat compound interest as a tool, not just for growth, but also as a warning about how quickly money owed can accumulate. 1. The real-life impact. Understanding compound interest changes how you approach money completely. It's not about get-rich-quick schemes or working endless hours. It's about making your money work for you. With early saving, consistent contributions, reinvesting interest, and choosing the right investments, you can achieve financial independence. Imagine retiring comfortably, funding your children's education, or taking a dream vacation. All because you use the power of compounding. Small actions today lead to big results over time. Compound interest is one of the few things in life where patience and consistency truly pay off in an exponential way. Compound interest is not magic. It's the result of time, consistency, and smart decisions. Start early, contribute regularly, choose investments wisely, and let your interest stay invested. Even small contributions can grow into life-changing amounts. Avoid high-interest debt, consider inflation, and let your money grow over years. The key is patience and persistence. By understanding and using compound interest, you give yourself a powerful advantage in achieving financial freedom. If this video helped you, make sure to like it, share it with friends, and subscribe to the channel for more practical money tips that can change your life. Start today and watch your future self thank you for it.